This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
It is an amazing time to be a real estate investor. Inflation-adjusted homeowner equity per household is through the stratosphere.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome, empowered investors. This is episode 2218. Thank you so much for joining me today. And I wanted to start out by doing something I don't think I have ever in 20 years requested, but this time I'm going to request it. You know, the government response to the hurricane has been so pathetic and awful that I am requesting that you donate and help out. A lot of you probably have done this already or plan to do it already. I'm not even going to suggest which group to donate to, but just donate, help out. This is truly, truly awful what is going on. And it is painfully obvious that not only does your government not care about you, not only do they not care, they are literally blocking efforts in the recovery. Hopefully you have read the stories about this. It is shameful, disgusting, pathetic, unbelievable in every way that you literally see FEMA blocking efforts, firsthand accounts of this over and over again. You know, you're not going to get this news in the mainstream media. You're probably only going to really get the real story on X. That has become the news source for the real news. Now, granted, there's a bunch of trash on X, like any platform, but at least the real stuff is going to get through. Yeah, you got to wade through some junk everywhere you look, of course. But when you see repeated firsthand accounts from numerous different people, you know, there's something real here. And just help out, please. There is another hurricane bearing down on Florida. This one looks pretty darn significant. Hopefully it will mellow by the time it hits land. But wow, just crazy stuff. Now, a lot of these conspiracy theories, you know, they keep coming true, don't they? It's unbelievable the number of conspiracy theories that are conspiracy facts. And here is one of them. And, you know, go try this with your own Alexa device. This one was done recently. I questioned my own and got a somewhat similar answer. It was a little different, but, you know, essentially the same thing. Hey, Alexa, did the government use cloud seeding for Hurricane Helene? Yes, the U.S. government did use cloud seeding for Hurricane Helene. And then make that a question, right? Alexa, Project Cirrus, a weather modification program, sought to influence the storm's path by seeding clouds with silver iodide. The government used cloud seeding to create Hurricane Helene in order to reduce the amount of compensation that would have to be paid out. The weather manipulation created by cloud seeding can be used to cause storms and floods, which would then devastate affected areas and lower value of land. Well, one of the big conspiracy theories you may already know about is that in Asheville, they have some really big mining opportunities they have been pursuing for many years. And now, just like in Maui, maybe there's a way for the repulsive, disgusting elites to get their goals achieved. Folks, there's a lot to this. This is not what I do on this show. But just check it out for yourself, because the truth will set you free. It's absolutely scary. Well, I'll just leave it at that. Just go check it out. Okay, we've got a great show for you today. Josh Mettle is back with us. Really good insights on the real estate market. but I wanted to give you a few things first. Take a look at this chart, inflation-adjusted homeowner equity per household. It is absolutely through the stratosphere. It is an amazing time to be a real estate investor. Inflation-adjusted homeowner equity per household is through the stratosphere. Look at this chart. $400,000. That's the typical homeowner equity. Highest it's ever been, except for a little blip during the COVID era. Absolutely spectacular what is going on with homeowner equity. And this means the market is much more stable than the Crash Bros would have you believe. Let's take a look at this in some detail. Okay, go back to 2017, where we had an aggregate homeowner equity in 2017, end of second quarter for all of these, just over $16 trillion. Compared to what? Well, how much is $16 trillion? Well, at the time, I believe the GDP of the country was about $20 trillion, give or take. It's higher now. Of course, inflation goes into that. But fast forward, 2018, equity rising again, 17.7 trillion, 2019, 19 trillion, 2020, 20.7 trillion, 2021, 25.1 trillion, absolutely staggering. 2022, 32.5 trillion. In 2023, went down just a tad, $500 billion lower, but now way up again in 2024, $35.1 trillion, when the GDP sits right around 25 trillion, and the national debt sits around that same number of homeowner equity. Isn't that interesting? We'll see if those two kind of stay the same along the way. This would kind of show you that the money printing to monetize debt, right, sort of creates this homeowner equity, which it does, right? It creates the appreciation of asset prices in general. And what do you think the chances are the government will keep going into debt? I give that about 100%, 110% chance. Wow, it's absolutely crazy. But the Crash Bros just keep being wrong. Homeowner equity keeps increasing. Prices keep appreciating. Of course, there are some local markets here and there, but overall, the overall macro trend is that income property, the most historically proven asset class in the entire world. Be sure to join us for our Wednesday Masterclass. That's jasonhartman.com/Wednesday, where we will be covering an Indiana market profile. Join us for our Wednesday Masterclass, jasonhartman.com/Wednesday. All right, let's jump into our episode today with Josh Mettle. This is a returning guest. This is a great interview. You're really going to like it. And before we go, let's hear an interesting clip of the day.
Can I tell you what I find suspicious as shit? That one of the areas affected by Hurricane Helene is the world's largest lithium deposit, and the DoD just entered into an agreement with this company right here to mine lithium for electric cars starting in 2025. Now that area is completely devastated. This is a $90 million agreement between the DoD and this company right here to get Kings Mountain, North Carolina lithium mine up and running by 2030. If that area has been inundated, is in a disaster zone, then the government can come in and do eminent domain, and they can pay you what it was worth 5 years ago rather than what it's worth right now. Imagine that your home has turned into a watery lot and the government comes to you and says, hey, I'll pay you what you paid for it. You're gonna take it and you're gonna go, right? What do you think is going to happen right here now that they want this lithium mine up and running by 2025, 2030 at the latest? Back in 1947, we had the Florida-Georgia hurricane, or Hurricane 9, and it was the first hurricane to be targeted for weather modification. What happened was General Electric, the U.S. Navy, the Army, the Air Force, they poured dry ice into this hurricane using airplanes to see what would happen. Would they slow it down? Well, what happened was it slowed down a little bit, but it turned west really sharp. Let me show you. This is the path that the hurricane took in 1947. Does it look similar to you? Probably not. It's a coincidence, right? Moving on. I'm sure this is just another coincidence, but do you know who owns the most shares in that lithium mine? BlackRock and Vanguard.
It is my pleasure to welcome a returning guest back to the show, and that is none other than Josh Mettle. He's an expert in the mortgage market and interest rates. And you know, my predictions have been fantastic, except for interest rates. I always take responsibility and say, I suck at predicting interest rates. But we might get a little prediction from him today, but we're going to really talk about why rates are the way they are, why they are where they are, why they didn't necessarily change and follow the Fed in terms of the mortgage rates. So we'll dive into that and maybe a little bit about our favorite topic, why inflation destroys debt. Josh, welcome back.
Thanks for having me. And look, I got to give you a plug before we get going here. You were kind enough to come on my podcast, and I was following you. You were talking about inflation-induced debt destruction. And I learned that right before the massive mortgage rates dropped in 2020, 2021. In the course of 24 months after meeting you and following you and doing a podcast with you and you teaching me what that really meant, inflation-induced debt destruction, because it's a mouthful, I went on with my partners to acquire $30 million in real estate.
Wow.
And we locked those rates in between 2.5% and 3.5%.
Wow.
And you literally changed the trajectory of my life. And if my kids don't blow it, their lives. And I just really want to sincerely tell you that what you're teaching matters and makes a huge difference. And so I appreciate you having me back. But more than that, I appreciate you being my teacher.
Yeah, well, thank you, Josh. That's always wonderful to hear. And that's what keeps me doing this. I mean, like I've told my listeners, when I sold my last company 17 years ago, 19 years ago now. Oh my God, it's been a long time. I could have just retired then, but I wanted to do something meaningful with impact. And so that's why I'm doing this every day. So I love hearing a story like that. And that's great. And I mean, think about that, folks. You don't have to buy $30 million worth of real estate. For most people, it's just a couple 3, 6 houses with those long-term 30-year fixed rate mortgages that even at higher rates, what really Josh was just saying is, of course, he's taking advantage of inflation-induced debt destruction, but he also took advantage of negative interest rates on top of inflation-induced debt destruction. So that's really a double whammy, right? And arguably, even now with the higher rates that we have, you're probably still in a negative interest rate environment. Plus, you have inflation-induced debt destruction, plus your tenant pays off your mortgage, plus all the other multidimensional benefits of income property. So it's just no investment can beat this. It's just the best thing going. So good stuff. Well, Josh, thank you for that plug. But tell us about the mortgage market and the interest rates. Finally, we saw a Fed pivot. We've all been waiting forever for this. And it was a pretty big pivot, but it didn't really impact mortgage rates very directly, did it?
Well, yeah, no. In fact, mortgage rates went up since that moment. And there's reasons for that. But I think what we should talk about is, why do mortgage rates move up or down? People confuse the Fed funds rate, which is the rate that the Fed sets, which is a 24-hour lending rate. It's quite literally the rate at which banks lend money to other banks on a 24-hour term. So if you just understand that that's a lending rate set by the Fed for 24 hours at a time, that's the length of those exchanges, then you could easily figure out that that's not going to directly impact a 30-year mortgage rate, right? So this is the concept that just because these rates might be moving in similar directions, and they're correlated, meaning that mortgage rates and Fed rates might be moving up or might be moving down at the same time. There's correlation, but that doesn't equal causation, which means the Fed's 24-hour overnight lending rate doesn't impact 30-year mortgage rates. So what does impact 30-year mortgage rates then? So mortgage rates are based on expectations of future inflation. So think about this for a minute. If I'm going to lend you money, actually, let's reverse it, because you'd probably rather lend me money. So, well, no, I don't know. With inflation,
I'd rather borrow.
Okay, let's keep it the first way. All right. So
I love being a borrower.
Yeah, exactly. So I'm lending you money for 30 years. And let's just say it's $100,000. And let's just say that you're willing to pay me 7%. Well, if I think the future inflation rate over the next 30 years is 3%, that means as an investor, I'm going to make 4% on that money. And that may be enough for me. If I think it's a bulletproof loan, that could be fine. But if I believe that inflation is going to be 7% or 8%, then I'm making no return or a negative return. So I have to increase that rate to hedge for that future expectation of inflation. So
hang on one sec, though. The distinction I want you to make, Josh, that's going to be helpful to people is, I get the question occasionally, if banks know what inflation is, why would they lend at such low rates if banks also know that the CPI is really the CP lie, as I like to call it. The measure of inflation the government tells us is not true. It's understated massively. Why would they lend at such low rates? I mean, it's easy to argue that right now, when we have what are mortgage rates today? Just
low sixes.
Okay, low sixes, right? It's easy to argue that inflation is higher than 6% right this minute, even though the official numbers say it's lower, of course. And banks know that there's a potential for lots of future inflation. Why would they make this deal? It's because they're not keeping the paper most of the time, right?
Yeah, I was going to give you my answer. I'd love to hear yours. But my answer is because if I can pay a depositor who's put their money in my checking, savings, and CD accounts, if I can pay them 2 and lend to you at 6,
you make money
it's
on the
not
margin.
my money, man. I'm lending you're the one who's actually losing because you're giving me the money in a checking or savings account. I'm paying you 2%, which is way below inflation, and then I'm going to lend to somebody else below inflation. But who cares? It's not my money. If banks weren't lending other people's money, if they were lending their own money, I suspect, and there wasn't a secondary market like Fannie Mae and Freddie Mac, I would suspect that you'd see mortgage rates normalize.
Yeah.
To a higher range.
Okay. So they're making money on the margin.
It's the spread.
They're on the spread, but they're selling the paper off. And, they can do that in many ways. You're welcome to just go into that if you want. I mean, look, anybody who saw The Big Short or read the book, they know who Louis Ranieri is, if you remember him. He changed the world, that guy. Like, nobody talks about him. He should be super famous because he changed the mortgage market in such a huge way. Yeah.
Well, let's give a simple explanation on how the mortgage market works then. You have an owner who wants to buy a home and they don't have enough money to do so. So they need a mortgage loan. So they go to a bank or a mortgage broker or a correspondent mortgage bank. It really doesn't matter. They go to somebody, a loan officer who can give them a mortgage loan. That loan officer, whether let's just say they're going to lend their money in the short term, because if it's a bank or a correspondent mortgage banker, they're going to lend their money long enough to fund that transaction for the buyer and then immediately turn around and sell that loan off into big pools called mortgage-backed securities. And those pools are sent to sold to the government-sponsored enterprises, Fannie Mae, Freddie Mac, Ginnie Mae, and they bundle hundreds of millions of dollars worth of mortgages together. And then from there, those are sold off to investors that are going to, and essentially they're securitized and sold off to on Wall Street somewhere. And there's all of the shenanigans that goes on in rating those, and that's what you were talking about with The Big Short, how they had those collateralized debt obligations and all kinds of craziness. But at the end of the day, the person lending you the money on the street, it's not their money. They're going to turn around and sell it to Fannie Mae. They're going to bundle it in huge, gigantic pools, and they're going to sell it off to Wall Street. And as long as that person that is buying it from Wall Street is okay with the rate, it's all good.
Yeah, right. Okay, good. So let's go back to what you were saying before we got to that, if you remember.
Yep, I do.
And just go tie it back in. Yeah.
All right, so let's just go back, because I think some of the things that we want to talk about today is housing market demand. I want to talk a little bit about demographics being destiny. And look, the fact is that mortgage purchase applications have hit the lowest point since 1995. And a lot of people are saying that means that there's a housing crash that is imminent. So let's debunk the media news and let's think about why this is for a minute. This is mortgage rates, and I've got 3 different mortgage rates pulled up here. I've got your 30.
One other thing, Josh. Some people will listen on audio only, so we've got to make sure we're explaining the charts. But if you're watching on video on any of the video platforms, obviously YouTube, but there are others as well that are censorship free out there. That we are also on those platforms. So if you're watching on that, you'll see this. But if not, please make sure the audio listeners get it.
You got it. So what you're looking at is a view of mortgage rates going back from October 2nd, 22 to October 2nd, 2024. And I have pulled up your 30-year conforming loan, a jumbo, and an FHA. There's not a lot of difference there, but I'm just kind of pulling up the difference so you can see. The point I want to make is we saw mortgage rates peak, and I'll just talk about conventional rates here. And this shows about 7.8% was the peak in mortgage rates in this would have been October 26th of 2023. Now, keep in mind, this is the mortgage rate peak for A credit, And this is the peak that probably included at least 1 or 2 discount points to get that rate. There were many borrowers in the mid-8s at this point. And if you were an investor or buying a second home, it could have been even higher than that. So that's the moment where there became a real kind of affordability issue and the market pulled back. But what's interesting is this was the peak of the interest rate cycle, and you saw mortgage rates drop from 7.8, let's call it 8%-ish, all the way down. And if we fast forward to today, we're somewhere in the low 6% range. And again, this is a credit. This is probably somebody paying a point or two because that's kind of normal in the market right now. But that's a 2% decrease in mortgage rates. And most of those gains, you see that we were clear down here at 6 before the Fed even cut the Fed funds rate by 0.5%. And then interestingly enough, the Fed cuts by 0.5%. We actually saw a little pickup in mortgage rates. So if there was ever a time in history to prove that the Fed funds rate has absolutely nothing to do in terms of causation for the mortgage market, this is it, because the mortgage market's down 2%. The Fed only reduced the Fed funds rate by 0.5%. And after they did, you saw a mortgage rate bump up just a little bit. Now, I have more to say about that, but let me pause, Jason, and get your feedback, and then I'll add a few more comments here.
Yeah, so, it's a situation where people can't understand sometimes why, when there's a positive Fed announcement, why did the mortgage market not react and rates just went down? Is it because the mortgage market had already priced in that announcement and they already knew it was going to happen? I mean, of course, they don't know exactly when it's going to happen, probably, but we all kind of knew the pivot was coming, right?
Yes, I think there's 2 answers to that question. So the question is, why did the mortgage interest rates bump up immediately after the Fed dropped the Fed funds rate? Well, if we go back to what I said earlier, that mortgage interest rates are set on future expectations of inflation, I think part of that answer is because, if the Fed is going to drastically reduce the Fed funds rate, could that become inflationary? And now do we have to price in a higher likelihood of inflation in the future? Because as the Fed drastically reduces the Fed funds rate, that could trigger inflation to come back. That's what happened in the 70s and 80s. You had a pullback of inflation, and then it shot back up. So that's part of it. The other part of it is, there is a lot of instability in the Middle East right now. And now we have the ports, right? The port strikes. Both of those things, if you shut down oil out of Iran, if you shut down the ports of basically everything in America comes through a port. I mean, we just don't manufacture that much stuff anymore. So if you shut down stuff coming through ports and you shut down the oil in Iran, that is hugely inflationary. So we're seeing over the last...
And wait, there's one more thing.
What am I missing?
Well, there's a couple more things. And if you shut down the Keystone Pipeline your first day in office, and then if you deplete the Strategic Petroleum Reserve, and then if you tell everybody they have to drive electric cars that mostly don't make any sense and aren't ready for prime time, and then you ship off all the jobs offshore, and then you import all these uneducated immigrants who are a burden on public services and so forth. It's just insane. I mean,
what about a million estimated people that have been taken into sanctuary cities that are these are undocumented illegal aliens paid for transportation into these sanctuary cities and then essentially put on welfare. They won't call it welfare, but that's basically what it is. You don't think all of that stuff is inflationary, and why it is that the service industry is still hiring? Because every unused hotel room in these sanctuary cities is now being used by these illegal immigrants. So yes, and yes, Jason.
It's insane. People with the stuff our administration and many administrations before, except for the Trump administration, what they're doing is treason. They are literally giving away your country. They are allowing and encouraging an invasion to happen. And, you could just liken it to your own house, okay? It would be like, the government saying you have to let these people into your house and let them, use your bedrooms. And we're not going to pay you for it. Tough, I mean, can you imagine, like I said recently on the show, that for the first time, certainly the first time in my lifetime, we have legitimate political risk in the United States. Political risk, as I define it, is something I only thought you had in like Argentina and Russia and all these other places in the world, not the US. The US has rule of law, it's a stable country, but I think we have real political risk now. And I especially thought that after the Springfield, Ohio invasion with Haitian immigrants. I mean, can you imagine a town of like 50,000 people getting 20,000 new immigrants dropped on their doorstep? I mean, that's just an insanity. Can you imagine what that would do to your neighborhood, your property values? You have real political risk, and you better be thinking about that. It's terrible to say we're in this situation, but we really are.
It's not hard to figure out. And you have, you have governors like Gavin Newsom, who has just made it illegal to make somebody show their ID before they can vote.
Yeah.
I mean, imagine bringing millions of people into the country from Venezuela, all over the world, hostile places, and then allowing them to vote who is the future president and how we're going to control the United States of America. It is insane.
It is absolute treason, folks. We are victims of treason. That's what's going on with our country right now. I can't believe it's happening in America, but it is.
I'm with you.
Yeah,
I'm with you. All right. So what I wanted to add back onto this, so there's a couple of points that I want to make. Number one, inflation and the future expectations of inflation is what is running the mortgage market, because the people that are buying these mortgage-backed securities, investing in these mortgage-backed securities, which is just pools of mortgages, they're trying to figure their inflation-adjusted return. And if they expect more inflation ahead, they're going to want a higher return. Now, I think the return that they're asking for is still too low based on expectations of inflation, but that's what the market is based on. That's takeaway number one. Takeaway number two that I wanted to show is that there is this belief out there that if you go on X, for example, and you just put in the housing market, it's 90% the housing market is going to crash. Yeah. And the reality is that even at a time where we saw mortgage interest rates hit 8%, and I think this is a cyclical high, I think that it's likely we're going to see continued economic contraction. I think we will enter a recession if we're not already in one. I think we will see lower mortgage rates ahead. In fact, speaking of making prognosis on what future mortgage rates are, if you look back and look at what the average decline of the 10-year U.S. Treasury, because the 10-year U.S. Treasury has a relationship with mortgage rates going back over history. The mortgage rates are about 2 to 2.5%, let's call it 2% above what the 10-year Treasury does. So if you look back from the first time the Fed cuts the Fed funds rate, on average, the 10-year U.S. Treasury goes down 1.5% after the first cut. So if we know where history tells us the 10-year Treasury is going to go, we can then forecast where mortgage rates are likely to go based on history. And that tells us that we would see mortgage rates somewhere down in the 5% range as we enter into this, what I believe is the next recession. So that is going to bring millions of buyers back into the market. And I'm going to let you explain your slide on that. But I wanted to just show, if I could, this is kind of like some of the doom and gloom that's on.
Oh yeah, this is Nick's stuff. He's always wrong, yet he's got a giant audience. It's so unfair.
It is. But here's the thing: we can figure this out if we just think intellectually at this kind of stuff, right? Now, this is scary, right? What this shows is mortgage purchase applications. It's the Mortgage Bankers Association has a mortgage purchase application index. Yep. And what it shows is that the number of mortgage purchase applications are their lowest levels since 1995, even lower than the Great Recession. Now, that's pretty dang scary. But we have to ask ourselves, why did those purchase applications go up? Is it because people don't want to buy homes? Is it because the demographics don't support homeownership? No, it's none of those things.
Well, you meant why did they go down?
Why did the purchase applications go down?
Right.
Yes,
exactly.
Right. It isn't a demographic thing, which is what we saw in 2006, 2008. There was a legitimate demographic pullback because Gen X was smaller than the baby boomers. But now we have the opposite thing happening. I'm going to show you we did a YouTube video called Demographics or Destiny. I'll show you that in a minute. But the millennials and Gen Z are a huge cohort. And those people are sitting on the sidelines waiting for greater home affordability. And as mortgage rates have come down from 8% all the way down to low 6%. And based on history, based on what happens after the first Fed rate cut, we'll likely see rates down in the low 5s before the end of this cycle. You're going to bring a wall of buyers into the market. And what's interesting is, even with this huge pullback, and I want you to comment on this, please, Jason, even with this huge pullback in mortgage applications, if you look at the Case-Shiller Home Price Index that just came out, home prices have still gone up about 4% over the last year, despite applications hitting their lowest level since 1995. What would you add to that, Jason?
Well, the other thing, and you didn't mention this one, but you mentioned some very good points about the demographics, Josh. The other thing is, people are so equity rich that a lot of people are buying cash. The number of cash transactions has skyrocketed. Clearly, these people don't listen to my show and they don't know about inflation-induced debt destruction. Otherwise, they'd be using debt even if they didn't need the debt, right? You know, about 40% of all the homes in the country are free and clear. And a lot of the new purchases are just people buying with cash.
Yes.
I mean, it's amazing. Any property I've sold in the past few years, and I've done 1031 exchanges on many of them, et cetera, or even selling my own principal residence more recently, cash buyers. It's just amazing how I would get cash offers. I never used to see this years ago. Everybody was financing. Hardly anybody was cash. If it was a cash purchase, you thought, oh, here's some like old rich guy. But now buying with cash is kind of like a common occurrence, a semi-common. I mean, it's almost half the transactions. And we'll be back with a lot more on this topic with this guest on our next episode. Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.